Welcome to this explainer. Most of us have been an employee at some point, and some of us are even employers. But how often do we actually stop to think about the financial footprint of a company's most complex asset, people? We usually think about business expenses as raw materials, real estate, or software licenses. But today, we're going to dig into the ledgers and uncover the absolute true cost of human labor.
Our source material really lays this out perfectly. Think about it. You can measure to the exact millimeter how much steel you're going to need to build a bridge, right? But trying to quantify a human being's motivation, or their bad days, or sudden bursts of inspiration, well, that requires a completely different and frankly much messier kind of accounting. Trying to control labor costs basically means attempting to predict and manage the sheer chaos of human behavior.
So, what is the actual true cost of an employee? Well, let's trace the financial life cycle of a worker to find out, because as we're going to see, the cash register starts ringing long before they even clock in for their very first shift. We're going to break down how every single stage of a worker's journey impacts the bottom line.
Section 1. The true cost of hiring. Let's just go ahead and shatter the illusion that an employee's only cost to a business is their monthly salary. Acquiring a human asset is incredibly expensive.
The labor recruitment process is honestly a multi-stage financial gauntlet. It demands heavy upfront investment at every single step. First, you've got job analysis just to figure out what you actually need. Then comes internal and external advertising. Next up is the interview and selection process. If you've ever sat through a grueling 4-round interview, just imagine the sheer amount of expensive management time being eaten up on the other side of that table. And finally, induction and placement, which is actually integrating that person into the company culture.
Literally before a new hire produces a single unit of value, the company has already bled cash paying for job ads, structured interview hours, and extensive training programs. You've got training needs analysis, assessing budgets, prioritizing critical skills. All of this happens before the employee is genuinely productive. It is a massive sunk cost, essentially a huge financial gamble where the company just has to cross its fingers and hope to earn it all back over time.
Section 2. Time versus output pay. So once that expensive new hire is actually through the door, the psychological tug-of-war begins. How do you properly incentivize a human being to work efficiently?
And this brilliantly illustrates the core dilemma. See, paying for time risks lazy idleness. You're basically paying someone to take a nap. But paying for output, piece by piece, risks sloppy, Frankenstein-level quality. With time-based pay, an employee has zero financial incentive to produce more than the bare minimum, which means you have to spend extra money on supervision just to make sure they're actually working. On the flip side, the piece rate method makes employees highly self-motivated to produce as much as possible, right? But then you might end up spending way more on quality control and inspection because they're rushing through the job.
To balance out that tension, companies sometimes use a guaranteed day rate. This acts as a safety net so workers aren't penalized on unusually slow production days. Let's say an employee is getting paid by the unit, but production completely stalls out. Maybe a machine fails or there's a material shortage. The guaranteed day rate ensures they still take home a baseline wage. It removes that extreme financial terror from the worker's shoulders while still keeping that piece rate carrot dangling right in front of them.
Section 3. The psychology of bonuses. Let's move to premium bonus schemes and see how this builds into a system of sharing extra profits when employees save the company time.
Instead of getting bogged down in algebra here, the core incentive is actually highly philosophical. Think about it. If you finish a 12-hour job in 6 hours, who exactly owns the time you just saved? If you pay the worker for the 6 hours they worked, the company reaps all the benefit. But if you pay them for the 12 hours the job was supposed to take, the worker gets all the benefit. Premium bonus schemes are specifically designed to share that extra profit.
Let's look at how two different schemes approach this. Under the Halsey scheme, it is a simple 50-50 split of the saved time. Save 6 hours, get paid a bonus for 3. Super easy. But the Rowan scheme uses a sliding proportional formula based on the proportion of time taken to time allowed. Now, why does this matter? Well, it actually protects the employer from paying out excessively massive bonuses if a worker finds some clever loophole to finish a job in record time. Both generate a really competitive spirit, just with different safety valves built into the math.
Let's look at a micro case study, a specific payroll breakdown for Clay Products Limited. The disparity is absolutely massive here. William's output clearly skyrockets his earnings far beyond his colleagues Michael and Gerald. William manufactured 1,080 units of product B, vastly outperforming Gerald's 480 and Michael's 168. Under a straight piece rate, William's paycheck becomes substantially larger, which really proves how individual incentives can create absolute powerhouse performers. Section 4, Lost Time and Ghost Workers. But humans aren't perfectly calibrated machines, are we? And eventually, that unpredictable human element introduces chaos and lost time into the accounting books. Not every hour paid is an hour worked.
Tracking every bureaucratic minute leads us to idle time. Normal idle time, like bathroom breaks or grabbing a coffee, that's just a reality of doing business. But abnormal idle time is when, say, a vital machine explodes because management completely forgot to maintain it and production halts for an entire day. That is considered controllable lost time. And that financial bleed has to be directly written off to the profit and loss account. Management literally has to answer for it.
But the ultimate human variable is outright crime. I'm talking about payroll fraud orchestrated through literal ghost workers haunting the ledgers. And no, not real ghosts. This is where the accounting system is manipulated to pay salaries to entirely fictitious employees, or maybe former workers who left years ago but are somehow still collecting a check. It is a massive drain on resources and requires incredibly strict internal checks to combat.
To bust these ghosts, strictly separating payroll duties is absolutely mandatory. Just think about it. The clerk who types up the wage sheet should never, ever be the same person handing out the cash packets. Otherwise, they can just pocket the phantom's pay themselves. Visually supervising pay distribution, having strict multi-level authorization for overtime, and setting up specific secure protocols for unclaimed wages are all completely required to stop paying salaries to phantoms.
Section 5. The price of turnover. Finally, we reach the very end of the employee life cycle, the day they quit, leaving a massive financial hemorrhage in their wake.
Now, a company's labor turnover rate might look really small on paper. Like an example measuring just 5 leavers against an average 200-person workforce, that's a mere 2.5%. But that tiny number is a devastating indicator of lost output. Because it's not just the empty desk, right? It's the lack of effort they probably put in during their final weeks and the agonizingly long lag time to get a brand new replacement up to their exact level of efficiency.
People leave for all sorts of diverse reasons. Whether it's dissatisfaction with working conditions, poor relationships with toxic supervisors, or personal matters like moving to a new area. But every single departure restarts that cycle we talked about, meaning the financial consequence to the company is identical. You are instantly dragged right back to the beginning of the hiring process. You're suddenly hit with new advertising expenses, interviewing costs, scrap from untrained hands, and massive administrative headaches.
Minimizing these turnover costs requires super proactive management, proving that keeping an employee happy is far, far cheaper than hiring their replacement. By ensuring a non-toxic work environment, offering real perks like solid pension schemes, and honestly simply treating workers like human beings rather than cogs in a machine, companies can drastically plug the financial leak of turnover. It's really all about developing better human relationships.
As we wrap up this explainer, remember that behind every single piece rate, bonus formula, and turnover statistic is a complex human being. The ledgers and accounting principles give us the tools to track the financial footprint, sure, but true efficiency comes from actually understanding the people generating those numbers. So, ask yourself, are you truly leading the people in your organization, or are you just managing their costs? Thanks for exploring the true price tag of human labor with us.